Hello everyone, this is the Chapter 1 discussion video. Chapter 1 was titled Managerial Accounting and Cost Concepts. As I mentioned previously, these discussion videos will focus on key topics from each chapter. They won't necessarily cover every single piece of the chapter or every single slide within the slide deck notes that I've provided. So as you know from reading in your textbook and sort of the introduction to this class, we are focused in this class on managerial accounting topics. So managerial accounting is very internally focused. It's concerned with providing information to managers so that they can make plans, control operations, and make decisions more broadly. These are operational decisions, organizational decisions, and so on. And we contrast that with financial accounting, and you've all taken a financial accounting class at this point, that's more concerned with reporting financial information to external parties, all the shareholders and owners, creditors, regulators, and so on. So Chapter 1 was all about cost concepts, and we have several reasons why we need to classify or categorize costs. First is we need to be able to assign cost to cost objects. Now, a cost object is just something about which we want cost information. So it could be a product, it could be a service, it could be a customer, right? It could be a division within the organization. All these things are our cost objects about which we want cost information and eventually profitability information. Now we are going to account for costs in manufacturing companies primarily. They just make the sort of fundamentals of cost classification a little easier to get through. We will talk a little bit though about accounting for cost in merchandising companies or resellers, as well as service organizations, since that's a huge part of the economy. We also need to be able to classify costs for purposes of preparing financial statements. So in particular, if we think about manufacturing companies, we need to delineate between product costs, those things that become part of cost of goods sold eventually, and period costs, all those other costs. We also want to be able to predict cost behavior in response to changes in activity. And activity just means, volume of production or other measure of activity if we're in some kind of service organization. So we'll talk about variable costs, fixed costs, and mixed costs. And then last but not least, this is sort of a catch-all, but classifying costs will also help us in making several different types of decisions within the organization. So our first learning objective was to understand cost classifications used for assigning cost to cost objects. First and foremost, direct costs versus indirect costs. Now, direct costs are those that can be easily, conveniently, I would also add reasonably or cost effectively traced to a unit of product or some other cost object. And our biggest buckets there were our direct materials and direct labor. So with the advent of technology, it's certainly easier for companies to trace more and more costs directly to individual cost objects, but there's always this element of reasonableness or cost effectiveness. How much sense does it really make to be able to trace some of these costs to each individual cost object? And we'll talk about some of those considerations as we go. On the other side, we have indirect costs. These are a whole bunch of different costs that cannot be easily or conveniently or cost effectively traced to one particular product or some other cost object. And in a manufacturing setting, that's our big bucket of manufacturing overhead costs. In a lot of organizations, that makes up a greater than 50% share of total costs. And we'll talk about some of those considerations as we go as well. Now on this side, we also have this notion of common costs. And those are indirect costs that are shared by two or more cost objects. So a lot of organizations that are delineated by division or group or subunit or anything like that have common or shared costs that really can't be traced directly to any individual unit or division or what have you. And even if we think about the university setting, like Clemson, you have the College of Business, College of Engineering, all these other colleges. The costs associated with overall university administration, like the president's salary, for example, are common costs of all those colleges. It's certainly a cost that's necessary for doing business and continuing the organization. But we can't trace that cost to the individual college in that example. So we'll talk about common costs a lot more as we go too. Our second learning objective here in Chapter 1 is to identify and give examples of the 3 manufacturing cost categories. And by the way, I'll say this several times, but manufacturing costs are also known as product costs, also known as inventoriable costs. And we'll talk about why that's a synonym for them in just a few minutes here. So our 3 big buckets there are direct materials, direct labor, and manufacturing overhead. Again, these are all manufacturing, aka product, aka inventoriable costs. Direct materials are some kind of material that becomes an integral part of the product that's being produced, and again can be conveniently, easily, or reasonably traced directly to it. So an example there, and I like to use automobile examples for a manufacturing setting because they tend to be pretty easy to visualize or very tangible. In-dash display units, so those audio units, nav units, and so on that are installed in an automobile, that'd be a direct material. As would wheels, tires, windshield glass, right? Side glass, upholstery for the interior. All these things are very easy to trace to an individual car that's kind of rolling down the assembly line. Next up, we have direct labor. Direct labor costs are labor costs that can be easily traced to individual units of product. In our automobile manufacturing example, wages paid to the assembly workers would be a good example there. So the folks that are riveting the doors onto the car frame, putting the wheels on the car frame as the cars come down the assembly line, their labor costs would be a good example of direct labor. I can trace the cost of those individuals' work directly to each car that comes down the line. And then that third category again was manufacturing overhead. That's every other manufacturing cost that's not direct materials or direct labor. So we can sort of do it by a process of elimination in some cases. If we decide that a cost is in fact a product cost or a manufacturing cost, so it's associated with the production process, it's happening in and around the factory and in and around those production processes. If it's not direct labor and it's not direct materials, it has to be this third category, manufacturing overhead. So that could include things like indirect materials. So some material we're using in the production process that we can't very reasonably trace to individual units of product. And the same for indirect labor costs. So labor costs of things like maintenance personnel, supervisors, and so on, they are associated with the production process. They are manufacturing costs, but they're not direct labor, so they fall into this big bucket of manufacturing overhead. Some other types of manufacturing overhead costs would be things like depreciation of our production equipment, utility costs for the factory or the production facility, property taxes, insurance premiums, even things like, I know some of these kind of sound like a stretch per se, but things like maintenance of the factory grounds or landscaping of the factory grounds, things like that. They are associated in and around this production process, in and around that production facility, so they might fall into that manufacturing overhead bucket. We got a couple quick definitions here for prime costs and conversion costs. So those 3 manufacturing cost buckets can be grouped together, if you will, to form our prime costs and our conversion costs. Prime costs are just those direct costs, so direct materials and direct labor. And then conversion costs, I like to think of as the costs incurred to convert, if you will, our raw materials into some finished product. So it's all the direct labor and all the manufacturing overhead that goes into that. Apart from manufacturing costs, on the other side of things, we have non-manufacturing costs. And these are also known as our period costs that we'll talk about in a few minutes. And our subcategories within that bucket are selling costs and admin costs. Selling costs are anything necessary to secure the order from customers, deliver the product, anything as part of that process of getting it into the hands of the customer, shipping costs and things like that. Now, selling costs can be direct or indirect. It just depends again on whether we can reasonably associate that cost with individual customers in that case. And then we've got that admin cost bucket. That's all of our executive costs, all of our top level organizational costs, clerical costs. Those things can also be direct or indirect depending on the cost object we're talking about. Also falling into that bucket would typically be things like human resources, information technology, legal support, accounting, finance, right? All these other organizational costs that are not associated with the selling process, certainly not associated with the production process, but still a necessary cost of doing business. Our third learning objective was to differentiate between product costs and period costs. And the reason we have to do that again is to put together financial statements at some point. We need to be able to say what was a cost of sales, what was a cost of goods sold, in other words, versus what was a period cost or something outside that production process. So product costs are all the costs that are involved in acquiring or making a product. Point is, all the costs incurred up to the point that the thing is ready to sell. Product costs do, at least in theory, attach to a unit of product as it's purchased or manufactured, and really they stay attached to that unit of product as long as it remains in inventory, again, up to the point it gets sold. So that's why we call these things inventoriable costs. So product costs, also known as inventoriable costs, also known, as we discussed a few minutes ago, as manufacturing costs. Those are one and the same. So for manufacturing companies, our product costs would include our raw materials, again, sort of the basic building blocks of whatever we're making if we're in a manufacturing setting. Work in process, which is also an inventory account, but that consists of things that are being currently worked on. They're not done and ready to sell yet. And then the third type of inventory is finished goods. Those are things that have been completely finished, as the name implies, and they're ready to sell, just haven't been sold yet. So we're going to talk more about the flow of costs in our cost systems in chapter 2 and 3 especially. But just for now, we need to think about kind of how these things move. So when direct materials are used in production, we transfer their costs from raw materials, that inventory account, to work in process, another inventory account, just to indicate again that these things are being worked on. Direct labor and manufacturing overhead costs would also be added to that work in process account as things are worked on. These are costs, again, we're incurring as part of the production process, getting this thing finished and ready to sell. Now, once these units are finished, their cost would be transferred from work in process to finished goods. That would be our cost of goods manufactured for the period. We'll talk more about that in a later chapter. I just wanted to introduce it real quick now. And then, and only then, when things are sold, pushed out the door to the customer, do costs hit the income statement at all. So costs would move from finished goods to an expense account, cost of goods sold, that you're familiar with from accounting principles. Okay, our fourth learning objective was to talk about cost behavior. So our primary types of costs there are variable costs, fixed costs, and mixed costs. We need to understand a little bit about how some costs move with changes in activity or volume. So really that's what cost behavior is trying to tell us or to determine, is does this cost react in any way to changes in the level of activity or volume within our production process. Now, the most common classifications are variable, fixed, and mixed costs. So first up is variable costs. Variable costs vary in total in direct proportion to changes in the level of activity. As such, they are also constant on a per unit basis, though. So if a cost is truly variable, if I double production, if I double output, if I make twice as many units of product, the cost should exactly double as well. So if we think back to my automobile example real quick, we said one direct material cost was the cost of wheels in the car, right? Every car has 4 wheels. If we're making 10 units of the same car, for example, we're going to need 40 wheels, right? The cost of wheels for each car is constant. 4 wheels per car, let's say our cost for those is $25 each. $100 per car then is the cost of the wheel. That doesn't change from first unit to the second unit to the third unit and so on. But that total cost of wheels would change in direct proportion to the number of cars I made. Right? $100 per car. If I'm making 1 car, the total cost is $100. If I'm making 2 cars, total cost is $200. 3 cars, $300, and so on, up through some, potentially infinite number of cars. That's a variable cost. The variable in the name is talking about the total. So it's varying in total with that change in activity. Constant on a per unit basis, though. For any cost that varies, we also need to think about a cost driver or an activity base. And really, that's just a measure of what causes the incurrence of that variable cost. What causes it to be incurred or to change as things change volume-wise. So that might be the units produced. It might be machine hours if we're talking about some automated piece of production. It might be labor hours if we're talking about a more manual process of production. It might be miles driven if we've got some kind of delivery activity happening here, one of our selling costs. Again, just a measure of what's causing the incurrence of this thing. Next up are our fixed costs. Those are costs that stay constant in total, regardless of changes in that level of activity. So fixed in the name, again, is referring to what that thing does in total. If we express fixed costs on a per unit basis, the average fixed cost per unit would vary inversely with the change in activity. But really, that's just happening on paper, because we're saying this cost is not changing in total. So if I ramp up production, if I make more units, really I'm just spreading that total cost out over more and more units. So on a per unit basis, it looks like it's decreasing. Again, really that's just kind of on paper. We have a couple different types of fixed costs. The first is committed. Those, as the name might imply, are really long-term and can't be changed, at least in a significant way, in the short term. So a lot of times for especially manufacturing companies, committed fixed costs are things like facilities costs, right? They build these big production facilities like Tesla's new Gigafactory in Austin there. Tons of costs go into that thing that really can't be changed in the short term as far as fixed facilities costs. On the other side, we have discretionary fixed costs. They may be altered in the short term by some kind of managerial decisions. So sometimes labor is actually a discretionary fixed cost. If we have a bunch of salaried workers and they get paid regardless of kind of production and such, they may be a fixed cost, but certainly a discretionary one. If we intend to change production in a significant way, we may add workers to that, so we may be increasing that fixed cost, or maybe laying people off and decreasing that fixed cost. One thing for us to keep in mind with regard to this idea of cost behavior is that we also need to consider a relevant range. So all of our assumptions about cost behavior are assumed to be held within some limited range of activity. In other words, if a company increases its production by 100-fold, 100 times, makes it 100 times bigger, our assumptions about cost behavior might not be valid anymore. So the relevant range defines some range of activity in which we expect to operate, and that's the range within which our assumptions about cost behavior kind of hold. Now, also within that relevant range, we assume that costs move basically linear in nature. Now, if you think about economics, and you've all taken some kind of micro or macroeconomics class at some point, economists talk about a curvilinear cost function. And that's the thing kind of pictured here. It's the squiggly line. But within the relevant range, we can make a pretty reasonable assumption that costs are linear. That's our accountant's straight line approximation of that curvilinear cost function. Again, we're saying that unit variable cost, for example, is constant within that range. It might not be strictly constant if we think about the sort of economics view of it, but within that relevant range, we can make that assumption. Now, the relevant range of activity pertains to fixed costs as well as variable costs. So, for example, assume we've got some office space that's available at a rental rate of $30,000 a year, but in increments of 1,000 square feet. So in this case, fixed cost of rent would increase in some kind of stepwise fashion at a rate of 30 grand for each additional 1,000 square feet we need. So in other words, if their company's currently using, half that, 500 square feet, they've got this fixed cost of rent of 30,000. If they need to expand space beyond that 1,000 square feet, they're going to have to do it in chunks of $30,000. So it's a fixed step cost. If we graph this thing out, it would look a bit like this. Right? For the first 1,000 feet rented, we've got that fixed cost of $30,000. If we need another 1,000, so 1,000 to 2,000, we jump up to the next step, and our fixed cost would be 60,000. If we need another 1,000, we jump up another 30,000 to 90,000 in total fixed cost, and so on and so on. So the relevant range of activity for a fixed cost is the range over which the graph of that cost is flat, okay, over which that cost is assumed to be fixed in total for any level of activity. So to summarize this real quick here, variable costs, again, are moving in total with changes in activity on a proportional basis. On a per unit basis, though, they're staying constant. Fixed costs are staying constant in total, regardless of activity, at least within that relevant range. And if we look at those on a per unit basis, we're going to see them decreasing as activity increases. We also have mixed costs in the real world. So a mixed cost is really just a cost that has a fixed and variable component. And the example here on this slide is utility costs. And if any of you have ever had a utility bill and looked at it, those are very good examples of mixed costs. Typically, there's some kind of service charge just for having availability of electric, water, gas, and so on, right? Some kind of connection charge. Then the second you turn the service on, you start to use kilowatt hours. If we're talking about electricity, that total cost increases from there. So a mixed cost, if you graph it out, looks a bit like this. It's going to have an intercept that's not at zero because we have some fixed component here. And then it's going to move up from that intercept in a linear fashion as activity increases. So those things change in total as activity increases, at least from zero. They also change on a per unit basis, though, because they have that fixed component that's decreasing on a per unit basis as activity increases. We can express mixed costs using this cost formula. We'll get to this in Appendix 5A when we use the high-low method to tease these things out. Total cost expressed by Y equals fixed cost portion expressed by A here, plus the variable cost per unit, B, times that activity level, X. So if your fixed monthly utility charge, for example, is $40 and your variable cost is 3 cents per kilowatt hour, boy, that's pretty cheap for power, and your monthly activity level is 2,000 kilowatt hours, we can determine that the total monthly bill is $100. That's the $40 fixed component, A, plus the 3 cent per kilowatt hour variable component, B, times that activity level of 2,000, or X. Again, we could use that cost formula to figure out what our expected utility bill would be for any level of activity, at least within some relevant range again. Okay, next up we wanted to understand the definition, if you will, of relevant costs and irrelevant costs, and also how differential costs, sunk costs, and opportunity costs fit in with some of this. So decisions involve, for our purposes anyway, picking between two or more alternatives. And the goal of any decision is to identify costs that are either relevant or irrelevant to that decision. To make decisions, then, it's essential to have a grasp on at least three concepts, I would say. This idea of differential costs, sunk costs, and opportunity costs. And some of these terms I know you're familiar with a little bit. I just want to make sure we're on the same page here. So a differential cost, or an incremental cost, is the difference in cost between any two alternatives. Okay, if we're talking about a revenue item instead, then we'll just call it a differential revenue. Both are always relevant to decisions. In fact, for a cost or revenue item to be relevant to a decision, it's got to differ between two or more alternatives. So if we're picking between option A and option B, in other words, if a particular cost item is the same between those, then we're not going to consider it relevant. It's got to be different to be relevant. Differential costs can be either fixed or variable, so we can't unequivocally say that cost behavior determines whether things are relevant or differential. Sunk costs are costs that have already been incurred, can't be changed now or with any decision we'd make in the future. So we're thinking about, for example, replacing a piece of equipment. The original purchase price of that equipment is a sunk cost. It happened long ago. We can't do anything about it going forward. So it's sunk, it's done. Those costs should always be ignored when making decisions. Again, because they can't be changed in the future with anything we do. We also have this idea of opportunity cost. An opportunity cost is really the potential benefit that's given up when one alternative is picked over another. Those costs you won't find on or in accounting records, but they are very important in really every decision. When we think about what's your opportunity cost you incur by attending class or by, in this case, watching this video, right? You've potentially given up leisure time or given up work time, and there's some benefit associated with that, like the pay you could earn at your job or whatever the case may be. So there's an opportunity cost involved with almost every decision we make in life. And certainly accounting decisions or operational decisions are no different. So opportunity cost, very important for us. A couple other things just to touch on real quick. We do need to classify costs for purposes of performance evaluation and differentiate between controllable and uncontrollable, but we'll come back to that in a later chapter. And then also with regard to process improvement, we want to be able to differentiate between value-added costs and non-value-added costs. And we'll come back to that later as well. Now, our sixth learning objective was to prepare income statements for a merchandising company, so a reseller, using a traditional format and our contribution format. And I gave sort of a precursor here on the slide. The nice thing about what we're doing here is that the top and bottom of the income statement doesn't change. What differs really is how we group stuff in the middle. So in our traditional format income statement, the one you saw in your accounting principles class, it started with sales and ended with net income, and we grouped costs by function. So above the line was all of our cost of goods sold to get us to this subtotal of gross margin. Below the line then was all of our other expenses, our selling and administrative expenses, to get us to net income. Now that format's typically used for external reporting. If you go view a company's public financial statements, that's the format you'll see. Now they'll have a lot of other things in here. This is a very condensed version, but it'll take this general form. Costs will be grouped by function. Now, new to this class is our contribution format income statement. It again starts with sales and ends with net income, but we group costs rather than by function, by behavior. So we group our variable expenses first, and that gets us to a new subtotal called contribution margin. In other words, what's left from sales that can contribute toward covering fixed expenses and generating a profit. Then below the line, we're going to have all of our fixed expenses. Once we deduct that, we'll get to net income. Now again, the top line and bottom line will not change here. Just have the same net income regardless of whether we're using the traditional format or the contribution format. It only changes how we group things in the middle here and what this subtotal tells us. Now this contribution format income statement you will not likely see in any public financial statements. It's primarily a tool used by management. It's a useful tool because it tells us something about our cost structure, what the relative proportion of variable and fixed expenses are in the business. And businesses typically wouldn't want to give that information away to competitors, right? You don't want your competitor to know that you're fixed cost heavy, or that you're variable cost heavy, or whatever the case may be. So we'll not probably see this published anywhere. Now, the contribution format income statement is used as an internal planning and decision-making tool. We're going to come back to this many, many more times. Just a few ways that we will are for cost, volume, profit analysis in Chapter 5. Also with our segmented reporting of profit data in Chapter 6. Certainly some of our budgeting considerations in Chapter 8 and beyond. And then also when we get to Chapter 13 and down the road, when we're thinking about pricing decisions or these make or buy analyses. So our contribution for an income statement and this idea of grouping costs by behavior, very important for cost accounting. Now, one thing I brought into the Chapter 1 notes was really from this Appendix 5A. So I brought in this Learning Objective 10 because I think it fits nicely here. That objective specifically was to analyze a mixed cost using a scatter graph plot in the high-low method. So we talked about breaking mixed costs into variable and fixed pieces. And in that Appendix 5A, we actually learn a little bit about how to do that. So just to recap from earlier, mixed cost is some cost that has a fixed component and a variable component. And we use this utility cost example. Now, a couple ways we can tease out the fixed and variable pieces are to use account analysis or an engineering approach. In account analysis, each account would be classified basically just on the analyst's knowledge of how the account behaves. And by analyst, we mean some kind of cost accountant. Could also be a consultant, could be a manager, someone who knows a lot about sort of the operations of this part of the business and can speak to how those costs move as activity increases or decreases. Now, the engineering approach shares some similarities there, but it would classify costs based on a more formal process. So we might have an industrial engineer come in or a process engineer come in and evaluate all the production methods, all the material, labor, and overhead requirements of our production process and make a very complex estimate of which costs move with activity and which do not. We also could use a scatter graph plot to get a rough idea of how things move with activity. So let's assume for a quick second here that we've got a maintenance cost. And we've got information on it from January through June, first 6 months of the year. We know the hours of maintenance and the total maintenance cost. Now, if we plotted this thing out here and we use total maintenance cost as the dependent variable on the y-axis there, and hours of maintenance as the independent variable, or the cost driver, if you will, on the x-axis, we can get a rough idea of what this thing does as activity increases, right? It's clearly not a fixed cost because it's moving upward as activity increases. We can't unequivocally say that it's, completely variable or mixed. It doesn't look like it's moving in direct proportion to changes in activity, but it's relatively close. So we might have to do a little more to figure out, well, do we think that has some fixed component or do we think it's truly variable? But bottom line is we can at least get a rough idea of how this thing moves with changes in activity by plotting that out. Now, as we said earlier as well, we can express mixed cost as this cost formula, total cost being the fixed piece A plus the variable cost per unit B times that level of activity X. And we gave the example as well for the utility bill, the $40 fixed cost and the 3 cent per kilowatt hour variable component, and how we could use that cost formula to predict a utility bill of $100 at 2,000 kilowatt hours. So that's essentially what the high-low method does. It helps us build that cost formula. With the high-low method, we lay out all the data we have for the particular cost. So this is the same maintenance cost as we used a minute ago from January through June. And what we do is we first take the highest and the lowest activity points. You want to be careful there that you don't use the highest and lowest cost points. Now, they generally should be the same if our cost is well behaved, but just to be sure, make sure we're using the highest and lowest activity points. So here the highest point is June of 850 hours of maintenance. The lowest point is February with 450 hours of maintenance. And the total cost at those points was $9,800 and $7,400 respectively. So the first step in using the high-low method is to find the variable cost per unit, or the portion that's moving with this change in activity. And the way we do that is take the change in total cost at the high and low points. So in this case, $9,800 minus $7,400, or $2,400, divided by the change in activity between the same points. 850 hours minus 450 hours, or 400, and then we do that division out. And what we're saying here is for this maintenance cost, the variable portion, the portion that moves with activity, in total anyway, is $6 per hour, approximately. Okay, so again, change in total cost divided by change in activity between the high and the low points. Then we can use what we know now, or what we're assuming now about the variable piece, to tease out the fixed part. So to do that, we'll take the total cost at either the high or the low point. So for the first example here, I used the high point, $9,800 total cost, minus the portion that we can now assume is variable, or moves with changes in activity. So the $6 per hour rate that we calculated a minute ago, times the activity at that same point, 850 hours. Do that math out, we get 9,800 minus 5,100 for total fixed cost of 4,700. Now we could also use the low point for that. So we could take 7,400 minus $6 times 450, and we get the same 4,700. So our total cost equation for maintenance then is $4,700 plus $6 times X. And again, we could use that to predict what our expected maintenance cost would be at any activity level within our relevant range. So if we came along and said, oh, well, let's figure out what the total maintenance cost would be at 600 hours of maintenance, we'd take 4,700 plus $6 times 600 hours, and that would be our expected total cost for maintenance for that period. I have another high-low problem in the practice problem video for this chapter, so be sure to check that out as well. Now, learning objective 11 was to analyze a mixed cost using a scatter graph plot in the least squares regression method. So the least squares regression method is a method used to analyze our mixed costs if the scatter graph plot reveals an approximately linear relationship, like our one did earlier, between the cost driver and that total cost. Regression methods, the nice thing about them is they use all the data points available to estimate the fixed and variable cost components of the mixed cost, rather than just two of the points like we did in the high-low method. The goal of this method is to fit a straight line, thinking linear, to that data using all those data points that minimizes the sum of the squared errors. So Excel or any other statistical package can be used to estimate the intercept, and that's the fixed cost piece, and the slope, that's the variable cost piece, that minimizes the sum of those squared errors. So you do need to pay attention to the statistical significance of coefficients. Now we're not going to really be doing regression in this class, but I did want to include this in kind of the walkthrough here, just for your purposes. The point is, at the bottom line, the cost analysis objective is the same. We're still looking to define this cost formula, the fixed piece plus that variable piece times, activity level. Now, least squares regression will also give us a statistic called the R-squared, coefficient of determination, which is a measure of the goodness of fit of that regression line to our data points. So we'll want that thing to be high, very close to 1. So I took the data from our maintenance cost example and plopped it in Excel and did that line of best fit, and this is what it spit out. It gave me a slope of 6.0192, so that's a variable piece, plus an intercept of 4,395.7, rounded off. So really that would be our cost formula. 4,395.70 plus 602 per maintenance hour. So pretty close to what we had using the high-low method. And that's because the data points we used, they do come pretty close to that kind of straight line, right? There's not a lot of outliers, there's not really any outliers, and everything's fairly close to that line. We also note that the R-squared here is 0.9217. That means that maintenance hours explains about 92% of the variation in maintenance cost. That's pretty good. Again, R-squared maxes out at 1.0 or 100%, so 92, in fact, it's probably higher than we'd see in practice for pretty much anything. Okay, so the two methods just discussed do provide different estimates of these fixed and variable components of a mixed cost. That again is due to the fact that the regression method uses all the points to come up with those estimates. The high-low method just uses the high-low. Technically, then we'd say the least squares regression method is probably going to be the most accurate. But a lot of times, and this is true even in practice in the real world, that high-low method does give results that are close enough and sort of easier to digest. Right? So with that, that concludes the Chapter 1/Appendix 5A discussion video. Be sure to check out the practice problem video and let me know if you have any questions. Talk to you next time.